This is a workshop on Farm Credit Mid-America workshop. And our person facilitating the workshop is Marcus Tyler Jr., who actively serves as the Emerging Market Business Development Manager for Farm Credit Mid-America. He is focused on supporting and enhancing Farm Credit Mid-America's traditional credit lending efforts. Excuse me, need to admit people their credit lending efforts, which have made the organization a national lending leader while delivering innovation programs and curating an ecosystem to support historically and socially disadvantaged producers and growers. Without further ado, I'll turn things over to Marcus Tyler Jr.
Mr. Magruder, I appreciate that introduction. Like I said, I'm excited to be here, and I appreciate the, all of you all who joined this the workshop. It sounded like there were a lot of great workshops going on, so for you all to join this one, it means everything to me. So I appreciate it. Like I said, I had some information that I wanted to share a little bit more about farm credit myself, and also our responsibility as a leading agricultural institution. So I'm gonna share my screen, and you all just, I guess if you could give me a thumbs up or a reaction if you can see my screen. Cool, perfect, I appreciate y'all. So before I get into anything, this is one of my favorite quotes. I actually have this written above my cubicle at work. But service is the rent we pay to live. It is the very purpose of life, and that's something that you do in your spare time. So like I said, I use this mantra every day that I approach my job at work. Every day I walk past my desk, I have there's a little area. We have different awards on these little cubicles that we got. It's there. So top inclusive company of 2021, most impactful organization, top diversive and inclusive environment. We have all these different scholarship programs where we assist our young scholars. So we donate to the next generation of scholarship recipients. We have a Growing Forward Award. So essentially this Growing Forward Award is called a Forward Thinker Award. And what we do is we honor an extraordinary individual for their amazing farming operation or farm business, right? We also have a brand new farming program that helps break the barriers that these young traditional farmers have, right? So providing them with education and financial literacy. So we do all these different things, right? We have all these programs to serve our young, traditional, beginning farmers. But what do we have for our smaller farmers? How are we impacting the space for our underserved and historically disadvantaged farmers? And to be honest with you, we haven't been. So we haven't been in that space. But like I said, Farm Credit does an amazing job. For 106 years, we've been able to serve rural agriculture, young traditional farmers, and we do that beautifully. We have all these different programs set in place. But like I said, what are we doing to further grow our local and regional food system by supporting underserved, urban, niche farms? So I'm excited to be in this role. I'm excited to have the opportunity to step into my journey with Farm Credit, and the company being willing to see that, though agriculture is broken down into urban and rural, ag is ag. And the only way in order to expand agriculture is to preserve it. And how do we do that? By further serving agriculture in its entirety. So again, like I said, that's my whole mantra. I just wanted to share that. And like I said, I'm gonna take the lead with that. And like I said, I have that above my my desk. So I'm not gonna hold you all too long, but again, as Mr. Magruder said, my name is Marcus Tyler. I've been working with Farm Credit for about 6 months. So it's fairly new. But I'm from and born and raised in Lexington, Kentucky, and Farm Credit is headquartered in Louisville, Kentucky. So it's always good to get back home, get closer to home, and serve this organization. I was actually a Farm Credit scholarship recipient in college. And I had a internship in high school with Farm Credit. So it's good to be a part of this organization that invested in me younger, that's invested in urban organizations and communities, but how can we further that by creating different initiatives to support our urban farmers? So that's my role within the company. I appreciate being here at the 2022 Black Farmers Conference. So today's goals, I'm gonna keep it short and simple. It's gonna be 3 key things. We're gonna understand who Farm Credit Mid-America is. I'm not sure how many of you all, well, matter of fact, by a show of hands, can't do a show of hands, but by the thumbs up sign, I guess, how many of you all are familiar with Farm Credit Mid-America or have heard of Farm Credit? If y'all can hit a quick thumbs up. Okay, you got 3. Okay, gotcha. Oh no, wait a minute. Okay. Perfect. And I was just curious to see what that looked like. Next, we're going to understand what a lender needs in order to make a loan decision. So what determines a credit-worthy applicant? And then lastly, why does a lender need that information? So when you're looking at potential lenders such as Farm Credit Mid-America, why do we look for the things that we look for? So it's pretty simple. We're going to hit those 3 things. So about Farm Credit Mid-America, Farm Credit Mid-America is a $32 billion lending cooperative. A lending cooperative, to be honest, when I began my journey with Farm Credit, my understanding of Farm Credit was we're a lending bank, a leading institution. So, in 1916, we were created by Congress. Essentially, banks loved investing in agriculture when agriculture was doing its thing. But agriculture requires, and farming, producing, growing requires a lot of faith. So there are times when agriculture hasn't always been thriving. So then banks tend to step back when it came to investing in agriculture. So Congress saw that farmers needed a fair, reliable source of funding. So that is why Farm Credit was founded. So there's over 67 different farm credit associations. Farm Credit Mid-America services you all. So in the states of Kentucky, Tennessee, Ohio, and Indiana is where Farm Credit Mid-America services. So like I said, we're a lending cooperative. A cooperative in a sense is a, I'm sure you've heard the term or the saying that, we work for you, or maybe in sales or somebody has told you, if you hire somebody to do something, or no, I work for you. But essentially that's what a cooperative does. So the success of our customers determines the success of our organization. I was just at a Western Kentucky small farms program. It was at Cherokee State Park, which was like the first non-segregated park in the South. So that was in Western Kentucky around Hardin County. But something that we talked about was the importance of lending cooperatives for the Black community. So essentially cooperatives back in the day that allowed us to increase our purchasing power, scale our operations, as well as limit variable and fixed costs. So essentially, a cooperative was an opportunity for underserved, historically disadvantaged farmers to utilize their resources to get ahead. So essentially, Farm Credit Mid-America adopts the same principle. So when you truly hear us say, we work for you, or your success determines our success, that's the truth. So also, for example, Farm Credit Mid-America customers, they have a voice when it comes to voting in, the board of directors, as well as like the mission of the company. So that's why Farm Credit has been able to operate so efficiently for 100 or so years, because we're truly invested in our customers. The second thing, obviously, we provide loans and leases to farmers and agricultural businesses and residents. And we have over 80 plus offices throughout the state of Indiana, Ohio, Kentucky, and Tennessee, like I was saying. So earlier I had mentioned a program called Growing Forward. So this is one of our newer programs that we have. Anyone can apply, but what this does is, it was launched in 2017, but it helps break those new barriers, existing barriers for young beginning farmers. So for example, actually Ariella was able to attend this year's conference. And so what that is, when you look at those common barriers of entry for young and beginning farmers, traditional farmers, whatever the case may be, you see collateral being an issue. You see, as far as being able to have or qualify for these loans being the issue as well. A lot of these programs available do more to hinder than help. So for example, if you're applying for a USDA loan, if you're applying for a USDA loan, though it may say it's available for socially disadvantaged farmers, you have to qualify by having like a minimum of 3 years of managerial experience. And typically, if you're a beginning farmer, you may not have it. So like I said, though there are existing programs out there, many of these programs do more to hinder than to help do their marketing tours. So like I said, this is just a program that we offer. So those who apply to this program and qualify, you get like tier 1 interest rates. Collateral is important. However, that's one of those things that we kind of push to the side, because if you're a beginning farmer, collateral is tough. You could maybe be renting the farm that you're utilizing as well. So in order to put that farmland up, it's unfair for a beginning farmer. So like I said, that's why one of those reduced barriers is not having that collateral necessary. Also, you have access to mentors, partnerships, so business development managers, experts who are in the industry to help you with planning. Essentially, it's not just giving you a loan, but holding your hand and walking you through that process. You know what I'm saying? Because it's one thing to give you a loan, but you also have to maintain and keep up with that loan. So this program, like I said, is fairly new, and we have a lot of different ways to help you thrive when you become a farm credit customer. So like I said, if you look in the middle, you see agriculture is calling, but just some of those accesses and some of those resources that these farmers have. So access to capital, you have relaxed lending standards. So typically we have different standards that you need to qualify for. And then in this presentation, I'm going to hit some of those standards, but those are relaxed under this program. Business plan work, you have mentors, and you also have the experience of collaborating with like-minded farmers. So this is a program or an initiative that we created to just give that extra oomph and help try to break down these major barriers. So these are just some requirements of the Growing Forward program. You have to be less than 35 years old or have less than 10 years farming experience, or your ask from Farm Credit has to be associated with a production risk. And so, I mean, that's typically in all cases when it has a production risk. So it doesn't need to be all 3 of these qualifiers, but you have to fall into one of these to qualify for this specific program that we offer. So some of those things, when I had first started working with Farm Credit, one of those biggest questions that I had was, why does Farm Credit require what they require? Every banking institution is different, from what they require. So we are called a earnings-based lender. So we make and generate our loans based off of your repayment capacity. So the things that we look for are a business plan, a balance sheet, and an income statement. So essentially 3 documents that you gotta have. And also something, this is personally though, how I feel, I've been able to have some interactions and discussions with farmers. And one of the biggest things that I've always heard was when, it's kind of intimidating at times when you're seeking a loan or funding, just because you're going into somewhere where you may not understand what exactly is needed from you. You may not know how to prepare those documents, but yet you're expected to share all your personal information, all your finances. And at first I was even starstruck, like that's not the most comfortable thing. You're going into a place where you haven't done business, but you're required to present all this information. So that's why it's also important to make sure that that I am able to meet you all where you're at. So that's one of the most important things as well, but not just requiring this, requiring that, understanding why you need that information, but still meeting you where you are. Because everybody is at different levels as to what they need funding, if they even need funding, or just understanding some of these basic financial statements that can help you personally. Because sometimes you may think you need funding and you really don't, but it's just about building that strong infrastructure. So we're going to get into the first thing, just a few key high-level points of a business plan and why that's essential. So 4 key things that a business plan should have. Any business plan, you can look online and find different templates, but a basic business plan should consist of a funding request, an outline of your goals and your objectives of what you plan to do with the funding, a SWOT analysis. So essentially SWOT is strengths, weaknesses, opportunities, and potential threats that can affect your business. And then lastly is to give insight into your management capacity. So who handles your record keeping? Who handles your management? Do you have a team that you work with? Who is all who all is invested in your operation. And so putting these things together is just the basis for a strong business plan. So like I said, here's just a resource over here to the right, but the Small Business Administration, SBA.gov. So they have business plans and things that you can follow. It's not a set way of how to do it, but there's tons of templates that you can do. So the elements of a good business plan. So what do we look for? What does a strong lending institution look for when you're creating a business plan? The first thing is realistic and measurable goals. And a great way to follow that is that SWOT analysis, like I said. So based off your current operation, what are your strengths? What are you doing well? The next one is your weaknesses. What can you improve in? And you got to be genuine too with this information. So what are some things that you can improve in? I always look at weaknesses as an area for opportunity, not essentially what you lack, but what you can strengthen, you know, so the opposite of your strengths. Your opportunities may be to expand in different markets, to market to a different group of customers, demographics, or even a different medium. So like a different tool, maybe a market. So, you know, you may be using CS or doing CSAs, but also how can you expand this to other reaches within your geography? So maybe doing, you know, through social media, Instagram, Facebook, different things like that. And then your threats. What are your potential threats? Threats are sometimes some of those things that you can't control as well. So environment, climate, things like that. Next time is the time and the effort put into the plan. So we understand that all these business plans may not be ready to go at the time, but still putting in your time and your effort into the plan, having a developed business plan is what we're looking for. Because once you apply for this amount of funding, someone is going to reach out to you to further examine it, to further discuss. So it may not need to be but it doesn't need to be 100% in order. But as long as you're taking your time and thoroughly put into your plan, your action, your passion, then it's going to work out as far as getting you the best options for funding. And lastly, like I said, having a plan that's growing to evolve within your operation. So the more that a lender knows about your operation, the better the partner can be. But also, like I said, I look at it as a two-way street. You know, the lender needs to know a lot of information about your operation. However, you have to feel comfortable about providing that information. And you have to put the time into your planning so that you do feel comfortable with giving that information. You know, so it's a two-way street. As Farm Credit, we're working to improve on meeting you where you are. You know, having opportunities like this to understand what is going on, what threats that you're having, what strengths of yours, what opportunities. And then, like I said, putting in that time to research to see how you as a producer can grow your operation. So it's a two-way street. The balance sheet. So we just looked at the business plan. Now let's look at the balance sheet. So the balance sheet shows the overall financial position of the operation or a person at a particular time. So essentially, in layman's terms, I like to look at a balance sheet as a snapshot. It's essentially a snapshot of where you are financially at a place in time. So a balance sheet is consistent of two things. You got your assets and your liabilities. Assets are anything that you own, anything that is a positive value that's bringing income. Liabilities are debts that you owe. So that's essentially what a balance sheet consists of, those two things. Now we can break those down. So when you look at a balance sheet, like I said, you have your assets on the left side and you have your liabilities on the right side. So when you look at it's broken into 4 quadrants, right? So the current assets are any assets that can be converted into cash within 12 months. So at the top left corner, like I said, it's breaking down into 4 quadrants, but look at it on the left side, assets, right side, liabilities. On the top left, you have current assets, anything that's bringing in money within 12 months, anything that you can liquefy and use it in a source of cash. So for example, that can be having cash on hand. It can be your feed. For example, if you have inventory or feed available, you can quickly liquefy that and turn that into cash if you need it. Your crops, your grain, whatever, anything that can quickly be turned into cash, right? If you look on your right side in the top right hand, liability. So anything that's owned within 12 months is your current liabilities. Now, if you look at the bottom on the left-hand side, it's non-current assets. That's any assets that you will retain within the past 12 months. So it's still assets, but you can't necessarily access it that quickly. So that's like real estate, equipment, vehicles, things like that, livestock as well. And then on the bottom right, it's pretty much the same principle. Non-current liabilities are liabilities that extend past 12 months. So, it's really just looking at it on an annual basis. Okay. So that's what majority of these documents are doing, looking at things on an annual basis. So a pro tip that I want to share. So it's funny, it's New Year's Eve. We interrupt the celebration and look at the year's end financials. So balance sheets are a big thing. So when you're looking at a balance sheet, like the previous slide mentioned, that you want to be consistent and as completely honest as possible, because it's providing a financial snapshot of your operation, what you have going on, your assets, what you owe, or what you bring in, and your liabilities, what you owe. So these should also line up with your taxes. So by having a balance sheet that is descriptive as possible, and you don't want to leave information out because that's fraud and you will go to jail. And I hope none of the 13 participants in here leave out information so it looks good, because you might be locked up or you're not gonna get the funding that you're looking for. But a balance sheets are a big deal, as long as you have an accurate, depictive balance sheet and you got your taxes, then we can complete an accrual. So what that is essentially putting these two pieces of information together: a balance sheet, your taxes, and allows us to get the total picture of your financial position. So that's an accrual is something that you don't have to worry about, but that's just something that we do on our behalf, just to get the right hues, the right picture, the right sketch, just get the full complete picture. Okay. So balance sheets are important. It's fairly simple. It's breaking down into assets, liabilities, current assets, current liabilities, non-current assets, non-current liabilities. And so kind of pro tip 3, just like I said, for example, the last bullet, if you're lying on the balance sheet, it's illegal, it's fraud, but I know you all are good stewards, so we ain't got to worry about that. Something I did want to share as far as assets that you don't technically own. So even if you're using machinery, even if you operate in land, but you don't technically own it and someone else has that ownership, you don't own that. So that's not something that you can put on your balance sheet. However, if you do have ownership stake in that, then you can own or claim up to 50% of that income or that debt. And then that's absolutely fine with including that on your balance sheet. So it's different tricks of the trade, different things that you can and you can't do when you're working with a good financial institution, that they're more than happy to, further describe what you can include. So looking at the balance sheet, so, like I said, that balance sheet gives us a snapshot, but why do we ask for a balance sheet? What are we looking for from a balance sheet? So the first thing is your total equity, your net worth. Net worth, assets minus liability gives us your net worth. Once you have all these, essentially your net worth is all the ownership that you have minus your current debt. That's how much that you have remainder. That's what you're worth. Lastly is the working capital. Working capital is simple. So it's your current assets. If we go back to that quadrant, your working capital is your current assets, what you currently own as bringing in income, minus your current liabilities, your current debts. That's all working capital is. Essentially, a working capital is basically saying how well or how soon you can handle adversity, anything that's unexpected. So if you look at your current operation and you look at your current your income minus your current debts, if anything was to happen, say a machine was to break down, say you were to lose some labor on your operation, somebody who helps you harvest or anything like that, how soon can you hire somebody else? Or do you even have money, or do you have working capital available to hire somebody else? So working capital is a very, very, very important component that we look at. And then lastly is solvency. So solvency is simple. How much of your assets do you own? If you own 55% of your assets, you own majority of it. So it's less debt that you pay, right? So there's key ratios for the working capital and solvency that we look at. We compute these, we take your balance sheet, your income statement, we put that into a system, and the algorithm produces us your ratio. So essentially, and I'll get into the slide later, I'll have some of our requirements or ratios, and you'll be able to see where you stand. So basically, the stronger these ratios, the more options that you have as a producer. So looking at total equity, I kind of broke that down. I was excited, so I kind of went ahead of these slides. But like I said, when it comes to equity, it's looking at your portion of ownership. All your assets minus what you owe, that's your equity. So that's the entire balance sheet, and you can either have a positive or a negative equity. You got a positive, you own more than what you have coming out. You have a negative, you owe more than what you have coming out. So for example, I just wanted to put this as well. Farmer Fred is what we call him. But if you're looking at his total equity, from 2020, about 2.3 million was his equity, right? We look at 2021, it decreased. So in your mind, for example, a financial officer, we're kind of looking at, dang, okay, his equity dropped. I wonder what by, not by much, but it still dropped. Still not bad at all. But some questions will be asked. Well, what are some of those things that caused his equity to drop? Now, when you're looking at a working capital, like I said, that's essentially all your assets minus your liabilities. That gives you your working capital, AKA how much money that you have to handle for adversities, things that are unexpected, right? So that's on the top half of the balance sheet, current assets minus current liabilities. If we go to Farmer Fred's working capital, he went from nearly $500,000 to $186,000. So his working capital decreased nearly $500,000. So that's a super red flag, because we're curious, well, what caused his working capital to decrease? If you have a strong sense in your working capital, that means, okay, something unexpectedly happens, so he's good. He doesn't have to dive into maybe his savings, but he has this money on hand to operate. So that's why it's also important when you make a profit to reinvest that back into your operation. Not to go out and buy a flat screen, a 72-inch, which I would really need right now, but just being smart about your finances. And then lastly is your equity to asset, which is your solvency. How much ownership do you have over your liabilities, essentially? So like here's a risk rating that we have. So anywhere from 55% being the least to 65%. So that's a margin that we look at. If you're under 55%, kind of question it, kind of curious to see how you're managing your operation or what you have going on. If you're above 65, that's amazing. You're doing your thing. So here's just a looking at Farmer Fred's equity. In 2020, it was at 60. In 21, it dropped to 55%. So his asset dropped. So maybe did he purchase some land? What caused his asset ratio to decrease? Did he bring on a new partner? So this is just some of the different ratios that are highly important. So if anything, when it comes to the balance sheet, just remember liquidity, how much money that you have on hand to solve issues, your solvency, how much ownership of your assets do you officially own? And then your equity, just what is your financial position? Do you owe more than you own, or do you own more than you owe? So those are three things just to keep in mind. Income statement. So your income statements are prepared using your taxes. So an income statement, different banks do different things. Essentially what we do is you bring your taxes into the bank and we look at your income statement. So we prepare an income based off of your taxes. Your income has your revenue for the year. It also has your expenses for the year, your depreciation. And that ultimately shows us your bottom line, which is your profitability. So key terms just to be aware, pretty simple. For example, your revenue, how much income you have from the sale of your goods, your services. Your expenses, all of the either the variable costs or the fixed costs. What are the expenses that it costs you to produce your goods and your services? Your depreciation is just essentially taxes or an expense that that you occur over time. So the decline in the value of your asset. And then value farm production. So that Schedule F form on your taxes is what a value farm production looks like. So I said that like I pretty much hit this, but like I said, this income statement is prepared using your tax returns, or if you're a beginning farmer. So essentially, these farmers in the Growing Forward program, they're new farmer. They may not have tax properly filled out tax returns or a good depiction as to, okay, they've only been operating for 6 months or a year, it's kind of difficult to paint that picture, right, on our perspective. So we use financial projections as well. So, using like a cash flow projection, or, your business plan. So some of those different things are able to help your income statement. So I like to look at it as, when I was in high school, or for example, when I was applying for colleges and scholarships, there was a scholarship for the College of Agriculture at UK that they offered, a big scholarship, cover majority of everything. Had to have a 21 score on the ACT. I ain't a test taker type of cat, but I scored a 19, the highest. So though I didn't, on paper, I was missing that aspect. I wasn't strong in that area. In high school, I had a 4.0 GPA. I was involved in extracurriculars, things like that. So it's kind of like, what offsetting strengths do you have or do you bring that can suffice for maybe something that you lack in? So even, having letters of support from other organizations, or showing that you work with a credit counselor or credit teacher or anything like that, to show I'm on the road to improvement, or I have support in this area, can help for something that you lack too. So that's something that is not really broadcasted, but to always keep that in mind, that there are offsetting strengths that you can have. So like I said, the most important things from a balance sheet is having your liquidity, solvency, equity, and a debt to coverage ratio. So a debt to coverage ratio is another ratio that we look at. Essentially, a debt to coverage ratio, and it'll be on another slide, but a debt to coverage ratio is how much of your debts can you plus an additional 30%. So like I said, we're a repayment-based lender. So we provide our loans based off the ability to repay loans. So a debt coverage ratio tells us how much debt coverage you can take in the case of something unforeseen happening. And I got a later slide to kind of show a formula which we do to calculate that. The reason why I wanted to put this slide was because I often get the question, well, how much is enough liquidity? And remember, liquidity is essentially how much working capital should I have in case to cover something that's unexpected. And regardless or not, if you're applying for funds from a loan, but just even from a personal tip, it's important to understand your liquidity, even in your household, personally, just to understand how much, they often say if you experience like a layoff or something, have around 3 to 6 months worth so you can cover your mortgage or just cost of living. So this is another term. Liquidity is something that you can apply personally, even if you're not looking for funding. But for example, one of our ratios for liquidity to measure a candidate's strength is less than 20% is a red flag. If you look at the bottom on the left-hand side, and then on the right, it's above 30%. So, if you have working capital, like for example, Fred's liquidity, Farmer Fred, his liquidity is 35%. So that's above our standard. But I just veered to the right real quick. But what I was saying was, when it comes to how much liquidity should you have on hand, it really determines based off of your farm production, your business. So everybody's is different, so it's subjective. So your working capital, like I said, your current assets minus your current liabilities, how much money that you have to operate in another sense, spread over the value of your business. That's how much liquidity you have. So it's subjective, because you can have a big farming operation that may have $50,000, $500,000 that they have in liquidity, and you may have a smaller farming organization that has $10,000 for liquidity. And just because you have that big discrepancy, it doesn't mean that one's better than the other. It all determines on the value of your farm. So that's exactly what I just said. It's just how much working capital do you need? It just determines on the size of your operation. Debt to cover ratio, like I mentioned earlier, but it's another ratio to determine your worthiness as far as handling a loan or credit, or just in general doing your thing in your personal finance. So what this ratio calculates is your total income minus your family living and income tax. So like your groceries, anything that's the cost of living, plus your depreciation and your loan interest cost. Basically your net income, how much money you bring in, all of your expenses, and that's divided by the years of the loan. So that's how we calculate this this debt to coverage ratio. And it's also important, it's not on this slide, but like I said, something to take into account is how much income you have minus all your expenses, plus an additional 30%. Just in case something happens, we want to see if you can handle plus an additional 30% of unexpected expenses or costs that happen. Please let me know how I'm looking on time. I think it's 45 where I was supposed to stop, but if I get too close, just please let me know.
You got about it's 2:40 right now.
Okay, cool. Sounds good. And then we'll do questions for like 10 minutes or so?
10 to 15.
Okay, cool. Just wanted to make sure I was knew where I was at, so I hit these. But credit scores. Credit scores essentially just determine how financially responsible you are. It's a lot of misconceptions that credit are a bad thing, that we should stay away from it. But the people who understand how to use credit, they use it all the time. People that have these huge, or farmers that have these huge farms, or people that have these bad cars, a rising house, they leverage their credit. Some of them may be doing it well, some may not, but credit score just determines how financially responsible you are. 3 different sources: your FICO, which is the most commonly used source of identifying or checking your credit, your experience, and plus score are other options. Your credit score, your ranges are from 300 to 850. Obviously, the higher the credit score, the better. People don't realize as well, when you get married too, you inherit that other person's sense of credit. So, say I got a 500 credit score and my fiance, she got an 800 credit score. She's gonna be mad at me because she could get a lot more than what she could, but now she can't. So that's her fault, because she should have checked that out before she married me. But luckily, that's not the situation. But it's important to know credit scores, the average of those 2 people, that affects your new credit score. So credit history. What is credit? What is the history of credit? What is credit broken down to? So the first thing is, the biggest component of a credit score is your outstanding credit, your limit. So if you got a $5,000 credit limit and you're at 4,000, it's gonna hit your credit pretty good. The length of the credit, your relationship. For example, like if you have a basically showing how long that you've been faithful to paying that line of credit. So that's what the length of relationship is. So, in college, I don't know, not saying I was, if I was that guy to move around from relationship to relationship, that don't look good at all. So it's not gonna have I'm not gonna be looked at in the sense of, oh, he knows what he's doing when it comes to dating. But if you use the length of your relationship, like in credit, you know what I mean? You're faithful to your credit, or paying it off of faithful to one partner. I don't know if that was the best example. That's what came to my head. Your type of credit, your credit inquiries. So there's soft pulls, hard pulls. If you're applying for a car, applying for a loan, certain ones have different hits. Obviously, something that requires more credit, that's more powerful, is going to hit you a little differently versus a soft pull. Checking your credit for a phone or something like that. Also, if you're getting your credit pulled, it's important to strategically set that. So, for example, go to different dealerships during in the course of a day, instead of scattering that out multiple days or throughout several weeks. You're going and checking your credit, because that has more effect. So if you were to strategically do that in one day, go to different dealerships, get your credit pulled, if that's what you do, it wouldn't really hurt your score, because you're getting it pulled one time within a set period, if that makes sense. And also your payment history just shows, like I said, another thing to show how responsible you are if you're paying your credit on time. So credit scores, lastly, just helpful hints to build your strong credit scores, to make your payments on time, have no more than 3 credit cards, keep your oldest card forever. Like I said, the length of the relationship of your credit is highly important. Limit your inquiries and credit histories. Try to squeeze them in a tight window. So like I said, if you can get your credit pulled or checked within a small window, that's way better than doing it over time, because it's going to accumulate. And then, as well as having different types of credit, but just showing how responsible you are to pay that credit. Also, this just brought a thought back. When I had mentioned that Growing Forward program, credit, we look at credit, but that's not essentially a measuring factor to determine if you qualify for the program as well, because you could be a new farmer, you don't have credit, or you can be a farmer who has struggled with credit. It's not something that we do to determine if you're credit worthy or loan ready or worthy, but it's just something that we look at still. So that's another thing of the Growing Forward program, is how credit doesn't have a huge lasting impact on if you qualify for that program. What you should expect is flexibility, financial tools and resources, communication, and financial analysis based off your information. So what you'd expect from a lender is somebody to be transparent with you, somebody to meet you where you are, understand your requests, have a genuine interest in your request and your operation. So someone to be flexible and work with you is what you should look for. And always, patience is a virtue too. So to always have that patience and not being so quick to jump on this process and get this done, because not everybody has your best interest, but to feel comfortable with who you work with in banking. And what your lender expects, like I said, these three key things, if you don't remember anything, is to have a good sense of your liquidity, solvency, and your debt to coverage ratio. So that is just the presentation as far as understanding where you stand financially, personally, and applying that to your life. And in a sense, what strong lending organizations look for when it comes to making these loans. So that's my contact, my cell, and my email. If you have any questions as far as like the program, if you qualify, if you want to take the time to go through some financial statements, documents, any questions, my contact is right here. So.
And we do have one question in the chat. And for those who are online, if you have other questions, please place them in the chat, and I'll go through those. And that first question is, for beginning farmers, can you describe advantages and disadvantages of applying as an individual versus creating some type of separate legal business structure for your farming operation, and different options for business structure? And that's from Lori Kuhn.
Absolutely, absolutely. So I would say it really depends. Honestly, it's subjective. It depends on what you're trying to do. It depends on the loan, the type of funding that you're looking to secure. It depends on what type of program that a bank may have available. But for example, if you're searching for a loan and you're using your LLC or any other type of another entity in your place, a good thing for that is that entity inherits that responsibility or that benefit. And you can put yourself down obviously for an employee or anything like that. So your bank can still lend to the organization. However, you don't necessarily have those ties to it. Also, yeah, I'll share my contact as well. Let me see if I can get to it. Sorry, I just saw that come up. And lastly, and it's another good thing too to use, an entity as well, because you can also, it doesn't dive into your personal credit score as well. So your bank can see that this LLC or this entity is a new bank. In certain situations, they may look at the personal credit score, but even if you do have good credit, you can use your personal credit score directed to your LLC, and then that works in the benefit as well. So you can get a stronger line of credit that way. So like I said, it really just depends on your stance, subjectively, what you're trying to do, what you're trying to use the funding for. But each bank is different. Each bank is different as well. But that's just some of the things to keep in mind too. So your personal credit score, as well as some programs offer different things to an entity versus a person. So it really just depends. If that answers your question. And can you all see the contact information, the slide?
Yes, it's clear.
Okay. Can you all see me?
Yep.
I'm sorry, Mr. McGraw. I didn't mean to cut you off.
Oh, no.
Can you all see me as well?
Yes.
Okay, cool. I feel like I'm 85 trying to work Zoom. Oh, my bad. I apologize, but okay.
While people are thinking of questions, a follow-up to that previous question, if it's a new entity, will that be looked at negatively because it doesn't have a history And would there be questions about that? And
For sure. I wouldn't say it will be looked at as negatively. Like I said, if it's a new entity, you can also leverage your personal information for kind of like that gain. So, you know, if it's a new entity, you've never taken out credit, you can use your personal stuff to, and just explain that, you know, and that's the reasoning of a strong business plan, your income statement as well, those financial documents, paint that picture. So that wouldn't be an issue. Um, and my bad, it was another part of that question.
no, that was it. Yeah.
Okay. Okay.
Are there other questions that anybody would like to place in the chat? Question is for a new entity. This is from Andrea. Is 3 years of financial projections enough, or how many years would you suggest?
Amazing. 3 years is just enough. And I didn't hit that, but it's exactly 3 years. You want to go at least back 3 years so you can see the evolution of your financial position. So 3 years is it. Just enough.
While folks are thinking about questions, for the Growing Forward program, what's the maybe average range of loan amounts there?
That's a good question. That's a really good question I'm not familiar with. Through the Growing Forward program, I can't tell, in the loan amounts just vary. I mean, the other day I saw we did a loan amount for maybe $15,000, and it can go all the way up to a couple million.
Okay.
And just because those loans range from agricultural loans to real estate loans, you know, so there's different types of loans, different types of components. But the Growing Forward program does have a success rate of over 75%. So a customer thoroughly going through the program, paying their loan back, and then becoming a traditional program. So, you know, it really starts, and I feel like anything starts with this, but this program is strong because of its educational component. So it's not, like I said, just giving you the loan, but it's walking with you to make sure that you understand and you thrive with that funding.
When you were discussing that, you mentioned tier 1 interest rate. Can you explain what that is?
Yeah, so tier 1 interest rates just means the best interest rates that we have available. So the interest rates fluctuate depending on the market. But when you apply for this loan, when you apply for this program and you become a Farm Credit customer, you receive tier 1 interest rate. So you receive the best interest rate that we have available at that time.
Okay. And there's a couple more questions in the chat. Now, Michelle is asking, what credit programs and grants do you recommend to assist co-ops?
Say that again, you kind of broke up.
What credit programs and grants do you recommend to assist co-ops?
Got you. So some credit programs that I've seen really help beginning underserved farmers, smaller scale farmers. Direct to market farmers would be FSA. So the FSA program. So they have a lot of coaching and collaboration depending on you know, what you're looking to do. So some of those FSA programs and offices have really good programs. In the state of Kentucky,
what does FSA stand for?
Farm Service Agency.
Okay.
Farm Service Agency. So there's different farm service agencies, and you can look at it depending on the county that you're in. And so they service that county. So they're connected with all different type of, you know, different financial programs. Something that we have in the state of Kentucky is called KCAR, Kentucky Center for Agriculture and Rural Development. So there's a lot of local organizations that have a strong emphasis on credit understanding. Another organization is SCORE too. If you look up SCORE, SCORE is a national organization, business management type of administration organization, but they provide counseling as well. I would say kind of thinking outside or thinking a little different, going to your local, wherever you get your taxes filed, there's typically somebody there, a credit counselor. But I will say it's a stronger need for understanding and how to utilize credit for sure. So like I said, I would love to encourage further discussion too. So please email me or give me a call, and I would love to see how we can possibly incorporate or initiate some type of programs.
And then Lori points out that there are some conference participants from states other than those served by Farm Credit Mid-America. Do other regional branches offer the same programs and terms?
Outside of Farm Credit Mid-America?
Right.
You know what, it's hard to say. There are different farm credit associations. Like I said, there's 67 or 69 different farm credit associations, and each one kind of offers their own version of what they do. Some of them don't, some of them do. For example, there's one in Illinois called Compeer, but they offer a program similar to Growing Forward, but it's called Emerging Market Program. And so each association has different things. But if you're ever curious to know what is applicable to you in your geography, in your area, you can always Google farm credit, and you can type in your location. So it's an area on the website where you can search by your zip code, and it'll bring up that farm credit that's close to you. And then you can always search and see what opportunities they have or give them a call too.
Okay. And then there's two more questions. Is Farm Credit considered a private lender?
Yes, yeah. Farm Credit is a private lender, yeah.
Okay. And that was from Community Solutions. And then Andrea asked, by going through the Growing Forward program, through its technical assistance, are you guaranteed a loan? And what is the percentage of approved loans through this program?
So with Growing Forward, you have to apply. And if you apply and you become a Farm Credit customer through that program, then you're able to have access to the education and the mentors. So you have to become a Farm Credit customer through Growing Forward. But actually, I'm actually working on creating something like a certification program where you don't necessarily have to become a program. At this Know to Grow conference I mentioned that Ariella was able to attend this past year, I was able to extend an invitation to those outside of our typical customer reach. And so that's beneficial. Instead of just being a customer, you only get these perks. What about those farmers outside who may not need to have a loan? Does that make sense? So like I said, I'm trying to create something right now where we're providing a certification program, where we're providing mentorship, financial literacy, education, policies, laws, local and state that affect you, depending on where you are, and then have the opportunity for grant. Because like I said, everybody's at different spectrums on the curve. You may need funding, you may not. You're looking to see if it's for you. So
Andrea has a follow-up question. She's asking, what do you think the timing would be for implementing those programs?
That's a good question. Right now, like I've been working with Farm Credit, like I said, 5-6 months. I'm thankful that my leadership is fully committed to it. So right now it's just about pulling in different pieces, different outside public and private institutions, universities to help develop their curriculum. So I couldn't give you a ETA, but no, it is in the process. And when it is completed, you'll hear about it. But like I said, to stay in contact with me, my contact is on this screen.
I mean, I have a question from the planning committee point of view for this. This is a Black Farmers Conference. Internally, I know you've been there less than a year, but do you see anything regarding Farm Credit's policies where they are expressing commitments to increasing lending to farmers of color?
Absolutely. So, like I said, Farm Credit, the mission of Farm Credit Mid-America is to serve rural communities and agriculture. Sometimes it gets misconstrued by Farm Credit serves rural communities in agriculture, but there's two different things. There's two different components. So like I said, you do have that when you look at agriculture, you have the urban and the rural divide, but we're going to continue to add to that divide if we keep breaking the two and being skeptical or being pessimistic about investing in agriculture that we're not familiar with. So like I said, we do have an organization called Black Soil that we support. And so what this organization does is out of Kentucky. So we provided $50,000 over the course of 4 years for them to develop high tunnels and other contributions to share with their partners. So we're invested in, if you want to call it urban agriculture, but don't get me wrong, it's always challenging for an organization to make a change when you're not familiar with it. So, you know, when you hear that term urban or so, people are invested, but it's going to take time because you're skeptical. We haven't invested in urban agriculture before. We assist urban organizations, we do this, but when I say invest in urban ag, we don't have a program developed. We don't have a microloan program developed, which I believe will truly help smaller scale or urban emerging market producers, however you want to categorize that. So that is my end goal.
Okay.
You know, not only provide grant, but how do we have a sufficient long-term means to extend credit? So like I said, that's what the goal is, and that will happen.
Okay, thank you so much. And we're right at 3 o'clock. So thank you so much, Marcus Tyler Jr., for your presentation for Farm Credit Mid-America. And for those who are planning to go to the other 3 o'clock workshop, now is the time to make that shift. And I know some people have come in for the 3 o'clock repeat of this presentation. And so we'll give folks coming in a couple more minutes and then we'll start.
Cool. Thank y'all so much. And thank you for the questions as well. I appreciate you, Mr. Magruder.
Oh, my pleasure.